Welcome back to the summit, and we have a very, very special treat for you here. I'd like to welcome Ben Bernanke to the summit. Thank you for joining us. I never thought I'd have an opportunity.
What an introduction! We might just well close the show right now. I don't know. Ben Bernanke. Yeah, thank you for that.
You look good, man. Like, this is a new look for you, Snider. You look good.
Yeah, I don't think my face matches my picture, but that's okay. If you're mistaking me for Ben Bernanke, I think I need to go back to the old way.
Imagine the head of the Federal Reserve was Jeff Snider. Oh boy, this would be interesting. Of course, those of you that know Jeff, and for those of you that don't, you're in for a treat. I'd more appropriately call him the plumber. I mean, he's the guy in the plumbing on the Fed and what's going on and all these different things. And I guess I got to start with that. Everyone all of a sudden wants to know about the SLR, Jeff. So maybe you just dive right down the toilet on that.
The supplementary leverage ratio cliff that's supposedly roiling the treasury markets. Yeah. Well, for those who are not familiar, the SLR is sort of the successor to capital ratios. In the wake of the first global financial crisis, authorities realized that capital ratios were essentially worthless because the banking system had found any number of ways to get around them, to stuff their balance sheets full of all sorts of risky assets. At the same time, maintaining within the guidelines of the Basel rule, making risky assets look like riskless assets, so they could create all sorts of leverage on their balance sheet, which of course unwound in a very messy manner in 2008. So in the wake of the 2008 crisis, authorities decided they were going to come up with some other way to mathematically describe what banks are up to, except now they wouldn't give them any sort of way to game their balance sheets or game their assets so that they could make them look better than they were. And so that's what the supplementary leverage ratio was basically a gross measure of a bank's exposure, and based on the size and based on the capital offsets and liquidity holdings and things like that, banks are given a set of rules and standards by which they have to follow because of their supplementary leverage ratio. And what happened last year, as the Treasury Department in particular, and also the Federal Reserve, as the Fed and the Treasury Department ramped up their anti-COVID efforts, their stimulus efforts, they obviously auctioned off a tremendous amount of Treasury bonds, notes, and bills. At the same time, the Fed underwent a massive expansion of its own balance sheet, which increased the level of bank reserves. Mm-hmm. Now, as the banking system absorbed both of those things, the authorities, including the FDIC and OCC, decided that we have to suspend the SLR. Otherwise, this could cause adverse effects because it will make banks' balance sheets expand too far, therefore causing all these negative, harmful liquidity side effects. Now, that temporary SLR exemption is scheduled to expire in about 2 weeks. So the idea is that with the SLR coming back into effect, all of these treasuries that the banking system has bought, all of these bank reserves that the banking system has added to its balance sheet because of quantitative easing, that's going to cause some sort of response on the part of the banking system. They're going to have to sell some assets to get underneath SLR thresholds or something like that, which is going to cause some sort of a lot of disruption in these marketplaces.
Well, that is clear and present danger 101 right now, like today. It's interesting. I don't know if you saw the conversation I had with George yesterday. I was basically going through, this, and he's like, well, I think that they're going to address it, but maybe only in the Q&A. And lo and behold, there he goes. You get it. You get the hand goes up, and Powell immediately said 2 days. So in 2 days. Is this like Cinderella, or in 2 days is it good or is it bad? I mean, the market today is actually telling you that it's going to be a non-extension of this SLR. Correct me if I'm wrong.
Yeah, and I think that Powell's position is, I don't think the Fed wants to extend it. And I think in some ways they're enacting something like negative interest rates in a macroprudential way. What I mean by that is they're forcing the banking system to face up to the SLR and say, look, if you want to hold only safe liquid assets, then pay the surcharge. If the surcharge is too high, you have to hold too many high quality liquid assets against your balance sheet, then go out and lend. I think that's, what the Fed has always tried to do is say, look, we want portfolio effects. We want to create policies that make banks take on risks. What better way to do that than to increase the balance sheet cost of holding safe assets?
Mm-hmm.
So I think the Fed is kind of saying, look, we want the banking system. You don't like low returns on treasuries, and it's going to cost you more in your balance sheet, then go out and do some more risky stuff with it. I think they're trying to do sort of a backdoor NERP kind of macroprudential way of forcing risk onto the bank's balance sheets.
Now, Goncalves was saying that they shouldn't do that, right? Like, because it's too fast, too soon. So why not just push for like 6 months and give that direction tomorrow? I mean, it wouldn't be. I mean, in our career, how many times, Jeff, has the Fed kicked the can down the road? So I mean, you're saying there's a chance. I mean, there's still a chance, particularly given what's happening in the bond market today, that they might even change that. I mean, we know, you and I know that they know that we know that Powell has a direct line to the big house, and it's not the prison, it's the big house, that runs Wall Street. And what are they calling him on today? I mean, could this possibly change, or did they already make a decision? Inside information's on the street, and people are like, shit, they're not going to extend that thing.
I think that's their position. Look, we've had a year here. This is not a surprise. This is not something that just came out of the blue. You've had months to prepare for this. I'm talking about the Fed's position.
Right.
I think what Powell's position is, look, we gave you guys all sorts of time. This stuff is not new information. It's been entirely predictable. So if this is a problem, it's your problem, not my problem. Now, of course, as you just are alluding to, the Federal Reserve will act tough in the beginning and say, yes, we want you guys to do this. But as soon as it becomes any sort of even minor problem, they have a tendency to turn into marshmallows and say, okay, sorry, we will give you what you want. And so I think it's right now we're in that transition period between the Fed. The market is saying, oh, crap, maybe this is real. And the Fed is trying to play tough cop or bad cop here. And eventually the Jay Powell gives in if the treasury rates get too far or too high.
Well, it's a classic game of chicken. I mean,
yeah.
On the call, which is our morning research product where we let people listen in to me talking back and forth, throwing it back and forth with the analysts. I was back and forth with our financials analyst, who I think Josh Snider, and I was like, well, do they think they know that they know, or do they think that they should know? And if they didn't know, really the market is flinching here. They're thinking that the big house or the big boys know. But if they don't know, which they shouldn't know, then nobody knows.
There's always that potential for a surprise, which I think is why the sell-off has gotten sharper as we get closer to the cliff. Is that maybe they're serious this time?
Yeah.
I think again, from the regulatory perspective, you can understand why they would pretend to be serious or appear to be serious, because they want to be serious regulators.
Right.
But at the end of the day, push comes to shove, I think people know the Fed is not going to push this thing any farther than whatever threshold they have assigned in their DSGE models. So it may be that it's already a preordained conclusion that if the market does this, then we back off. But up to a certain threshold, we're going to pretend to be the bad cop and enforce the SLF cliff.
Yeah, they're really not bad cops when it comes to Wall Street.
No,
come on. Now on the causal, let's take a big step back, because a lot of people, buy-siders, apologists, now all the newfound bond market experts that only follow equities know. Everybody thinks they know, but not many people had the causal effect right, like what is, at least I think, is the causal effect, and I wanted you to touch on that, which is this combo of growth and inflation accelerating at the same time and slowly then all at once. That driving the long end of the curve and having a pseudo promise that we will do yield curve control on the short end if we ever have a problem. Do you agree with that? Because by my math, this started back at the end of October and into November, the breakout in bond yields did. And now we're just seeing an excuse, so to speak, to say, well, that's really this technical thing that's driving bond yields higher too.
Yeah, I think underneath all of this SLF stuff, I think the SLF stuff is real.
Yeah,
I think there is actual selling going on, but you're right. The underneath premise is the fact that the economy is getting better. Things are looking up. And the real meat of the sell-off goes back to early January, which is when we got more concrete visibility on fiscal stimulus and fiscal approach and things like that. So there has definitely been an uptick in optimism, especially that it has come out in the same way of reflationary trades that we've seen time and time again, that the market is adjusting to how last year was really bad, and maybe moving forward, it won't be so bad. And that's really what the reflation trade is. I think it's an adjustment, an upward adjustment to outlook of, as you said, Keith, both growth and inflation.
Now we have what you've addressed. That's just the U.S. That's the U.S. piece. Actually, we called it Global Quad 2 for a reason. For a period of time, guys, flip slide 20 on the board, just showing the G20. Quad 2 is where you have growth and inflation accelerating at the same time. We had a very unique situation where bloody well every country other than China now was in Quad 2. But China's the first one, and you called it inflation tour stop number 1, China. So I wanted to, when you tweeted that, I'm like, okay, I got a yellow light there. That's a 3. That's not a Quad 2. That means that the real growth rate in China is starting to slow. It's more like stagflation. 1, do you agree with that? And 2, do you think that that's going to impact inflation expectations?
Yeah, and China usually is a leading economy anyway. So if the Chinese are getting better, you can pretty much assume that the rest of the world will eventually follow. And conversely, if the Chinese economy is starting to slow and even roll over, you can bet that the rest of the global economy is going to follow eventually too. And what we're seeing, what I see from China is that last year wasn't as good as maybe people are expecting or have been talking about, and there's no real appetite to make it any different. Policy-wise, the Communist Party stance, monetary policy, fiscal policy has all turned neutral, and we're told that it's going to remain neutral because the Chinese authorities have said this is it. This is the economy that we have. And we're not going to go nuts trying to create economic growth that we don't think is legitimate and sustainable. And so, if the Chinese economy isn't performing all that well to begin with, and the authorities are not going to come riding to the rescue, then you would expect to see some warning signs or some undershooting in the Chinese economy in any number of different ways.
Now, if you guys, if you go to slide 52, because I always remind people that don't do macro, like you have to have the long-term, secular, long-term, and then you put the cycle in context. We just had a big rip in everything growth globally, including Chinese growth. I'm showing secondary industry growth, which you're obviously familiar with, but old China. Now, our estimate or nowcast is that we've seen another lower high in the growth rate. China's industrial economy is well past peak. And now we're going to have another cyclical slowdown within a secular picture that's fully loaded with demographics and industrial production growth that's not good. I mean, one, do you agree with that? Some people take that chart and they're like, hey, well, it's not that bad. No, they don't do rate of change.
It's not that bad if you're China, but I think the rest of the world is saying we need China. We need excess growth. We can't go without China. No, and I think that's exactly right. Well, the Chinese economy isn't what it used to be, and the authorities recognize it isn't what it used to be, and so they're not going to waste their time trying to stimulate the system into something that it can't be. They're going to create more asset bubbles and more wasteful and inefficient spending. That's just not going to happen. And part of the reason I would add that we have the secular underlying thesis, which is negative, is that they have a monetary problem. They have a dollar shortage problem that they can't seem to get around, right, which creates all sorts of internal drags as well. And I would also add that the Chinese internal economy hasn't performed well at all. In fact, you look at retail sales, for example, Chinese consumers over the last year have performed markedly worse than any other parts of the Chinese economy. So if the industrial sector, the tertiary or the secondary industries represent the high water mark of the most recent rebound, what are we looking at underneath all that, which might be where the Chinese economy eventually reverts to? And retail sales, yeah, I mean, that's the other thing. We're getting into a period where we're comparing to the trough last year. So a lot of the base effects and the economic numbers that are coming out appear to be absolutely tremendous. But when you set those aside and look at where China's economy maybe should have been had there never been a COVID, it continues to be way, way behind. And Li Keqiang, the premier for China, came out recently and said, look, our growth target for 2021 is over 6%. And I think a lot of people were thinking more like 8, 9, maybe even double digits in GDP growth this year, whereas 6% following a year where they barely got 2% represents a really big challenge for the rest of the world.
Mm-hmm. Well, people, again, if if you have the historical time series emblazoned in your melon like I do or like you do, that makes sense, because you remember at the end of the globally synchronized recovery into the beginning of 2018, when China started to slow, they were just making up their headline GDP number anyway. In secondary industry growth had been slowing. They're basically making up the number to get to this round 6 or 7, and now they're just saying, okay, well, I don't have the upside anymore, so why don't we just go with the 6? I mean, there is a serious making up of numbers in China when it comes to that, but for whatever reason, and I don't think they're watching us unless they really think that you're Ben Bernanke. They might actually be, they might be logged in. They might have heard that Bernanke was speaking to me, but in the absence of that, they're probably not watching this, and they're probably not going to change their reported secondary industry growth. To me, that's like the best. That's the best time series in China, because for whatever reason they haven't made that number up yet. At least not in gross exaggeration like a lot of other numbers.
Well, it's harder to fudge in secondary industry than it is, say, local government spending. That's right. An easy one to fudge, right? But I think what was interesting about their GDP targets was they kept, whether intentional or not, they kept incrementally dropping them. They kept getting smaller and smaller and smaller, which was sort of their concession that, look, we're not growing. Something's changed here. We're not doing the same things that we used to do. And I think that goes back to, the political question, which since the 19th Party Congress in October 2017 has been, quote unquote, quality growth rather than quantity growth. Yeah. The Chinese are basically advertising that this is a new era in the Chinese economy, and that they're just going to kind of roll with it. Whatever happens, happens. And they're not going to try to fight against the underlying trend, which, as you point out, and I think you point out very well, Keith, is that the underlying trend is not one that's accelerating. It's not conducive to an overall global inflationary environment, because the Chinese economy isn't filling the role that the rest of the global economy has pictured for it.
Yeah, again, if you're aware, again, slide 52, that's a long-term cycle chart of secondary industry growth in China. It peaked at the beginning of the chart and has been making a series of lower highs. And again, I want to talk about this dollar shortage that they have and the dynamics of that. There's a series of cyclicalities to have been aware of. But one of the earliest lessons, Jeff, that I was ever taught in macro was from Bob Schiller. He would basically take he'd say, okay, this is a 100-year chart. In the case, I think is it not the Chinese having their 100-year Communist Party this summer or something like that? Is that
where we're coming up?
So let's use 100. We go 100, and then we just say, well, what is the chart doing over the long term? Is it doing that? Is it making a series of lower highs? Well, now you're hostage to mean reversion. That's a very think about what the value is of an education in New Haven. Really, I mean that's all I had to know. That's it. So you get mean reversions within lower highs, and then you got political problems after the 100-year party. So can you go to
I think that's really, there's two parts of this, right? It's not just economic issues. There's political issues. There's a political part of this. As the Chinese economy slows down, that represents a lot of danger to the Communist Party, because look, they haven't finished their urban transformation. They haven't said, we've created the wealthy society that Deng Xiaoping set out to do 30 years ago. We only got partway there, and now we're gonna say, hey, we're done. The economy's full up. We've hit our wealth peak. Well, there's a couple 100 million peasants in China that are nothing more than subsistence farmers who are saying, look, we put up with a lot of crap over the last 30 years with the promise that, even if we didn't get to end up in these brand new cities that are beautiful and modern and middle-class lifestyle, that maybe our children would. And now you're telling me that we put up with all this stuff and neither us or our children actually get to go off into these cities. It's not just an economic issue for the Chinese, it's absolutely a political issue as well.
And that's why they changed their political mandate explicitly. And I say that to people all the time when we have institutional meetings. It's they've decided no more building of empty cities and all this industrial production growth. They need social harmony or they will get killed. The current kings will get killed. The people kill the king. Now, it doesn't go any other way around that. Ben Bernanke's not going to kill him.
Any historically top-heavy system is always inherently fragile. And the Chinese absolutely know this. I mean, look, they studied the collapse of the Soviet Union and the Eastern Bloc to the nth degree. They sent teams of researchers all across the communist neighbors to say, how do we avoid that fate? We don't want to be the Soviets. And one of the things they said was, well, we need to get much wealthier. We need to create a modern society and a modern economy. But they could only go so far with it when you're the export factory builder of the world, right? Eventually, you're dependent upon globalization and world growth. And if that underlying trend in globalization starts to falter or fall away, what are you left with? And I think that's why Xi Jinping in particular said, we're going to go back to Mao. We're going to go back to the way things used to be done, because this 30-year trend under Deng's version of Chinese socialism with Chinese characteristics has reached its logical end. At least I think that's the Chinese position. And getting back to what you just said with the underlying chart, yeah, there's ups and downs, but mean reversion here is lower over time.
Yeah, lower for longer. And what you'll find is, if you've studied demographics to the extent that, our in-house view, Neil Howe is one of the world's best, of course. But again, if I just take his data and put it in a long-term time series using the classic Bob Shiller analysis, you are seeing lower lows and lower highs across the board in particularly old China, and that is what it is. The reason why I'm bringing Jeff Snider in on both ends of this, because this, to me, for the plumber, is where all the shit needs to be understood, right? You take the U.S. Federal Reserve and you have their plumbing problems, and you take China, which is got a dollar shortage. You mentioned that; those words are really important, and you cannot separate this pipe. You cannot separate this pipe and say, well, I have my connections at the Fed. I know what they're going to do on this SLR. Blah 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 blah. Why? One, do you agree with that? Because that's what I wanted you to do. Because very few people can talk, cyclically about both countries and then tie the plumbing together.
Well, first of all, the Fed doesn't, the Fed and China are completely separate issues, because the Federal Reserve, to me, is nothing more than a domestic bank regulator. And if you asked them and made them admit to you, they would tell you, yes, our mandate ends at the boundary of the United States border. Whatever happens in the dollar system, they recognize there is a dollar system outside the United States.
That's nice.
But whatever happens with it is somebody else's problem. That has been their position from the very beginning.
Right.
So are these offshore dollars, of which China and the rest of the world are a part, who is responsible for them? Well, nobody is. The Federal Reserve would say that's not our problem. Go back to the 2008 crisis, for example. You had the euro-dollar breakdown in London. You can read throughout the transcripts in 2007 when they had these crisis discussions. A lot of the Fed members said this is a Bank of England problem, not a Federal Reserve problem. Even though the banks that were breaking down they were located in London, but they were trading in dollars. And so the dollar shortage that exists outside the United States is also outside the Federal Reserve's legal mandate, as well as its intellectual framework. And so that's why time and time again, when confronted with at least acute dollar shortages like we saw last year, the Federal Reserve falls back upon these overseas dollar swaps, where its solution is to offer bank reserves to foreign central banks, and then those foreign central banks are supposed to go into the marketplace, their local marketplace, for dollars and alleviate the shortage. But what we find time and time again is that it's an ineffective way, and most of all, those dollars end up back in the United States anyway. They just sort of round trip back and leave the rest of the global system dry for dollars, which is a huge problem because the world absolutely needs dollars.
Well, that's my point. The intellectual mandate and the political mandate, they're separate things. But the pipes of the global global capital market system are connected.
Yeah, and it takes a lot to say it's not our problem, right? I mean, it's not. Don't look at us. We don't. I mean, that's England. That's China. That's not us. And I think there's a misconception there amongst the public too, because we're talking about supposedly a dollar system, but really it's a global banking system that trades primarily in U.S. dollar denominations, the U.S. dollar denominated bank assets and liabilities. Which, again, if you're a domestic bank regulator, it's easy to say it's not my job, it's not my mandate. We're going to pay attention to the domestic banking system, and we're going to simply assume that if we fix the domestic banking system or give it what it wants, that somehow, some way, it will find a way to figure out what's going on in the rest of the world.
Well, that's unfortunate because that doesn't change the risk. I mean, so you end
up... No,
and
it explains a lot about the last 13 years, though, doesn't it?
Yeah,
because,
it does.
We keep having these repeated overseas offshore problems, which authorities in the U.S. kind of look away, and authorities out overseas look away, too. In fact, this is one of the things that economists and central bankers, and even Treasury Department officials had talked about in the 1960s and 1970s when this Eurodollar system first showed up. They kept game planning, at least in their minds, what would happen if the system breaks down? Who is going to step in and be responsible for all of these dollars that are floating around offshore and all of these dollars that are floating around nowadays in all sorts of different formats? There's no actual currency here. These are all derivative transactions. Right. So who is responsible for that? And they simply just decided over the 80s and 90s, this so-called great moderation, that it didn't matter. So nobody ever stepped in and said, look, we'll be responsible for the global banking system. We'll just hope that the Basel rules construct useful measures and we can head off any crisis before it happens. And of course, 2008 came along and showed that was a ridiculous assumption to begin with, but nothing has changed since then. In fact, we're still doing the same thing. We talk about repo and collateral shortages, things like we're still talking about these things 13 years later because the Federal Reserve has such a simplistic view of its own mandate as well as how it's supposed to meet its mandate.
Again, it's ironic that you got the Bernanke look because what I found super ironic about a dollar-denominated global macro market system is that he would never talk about it. He didn't have any impact on the dollar. Why would he do that? He devalued it to a 40-year low in 2011. That's commodities hit an all-time high in dollars because 86% of those settle in dollars. Like, to me, it's like I think who said it the other day? I think it was Mike Green. Do you know Mike Green?
Yes.
Yeah, Mike Green's he was excited because the way he saw it, and I agree with this, is that we're about to have a new dawn in terms of our profession because you just can't stay with linear assumptions, linear thinking, these institutions that do both. And that is really the opportunity, is conversations like this. But unfortunately, for Mike Green and I and all the glory that could be the future state of looking at things fractally, shit's got to blow up again before that happens. Shit's got to blow up. But
I don't know, blow up. I think there has to be a transition period, and transition periods usually are very messy. They don't necessarily have to blow up, but we can have a messy transition period that isn't the worst of the worst case.
Well, give me a couple of those.
That's exactly right.
Give me a couple of messy situations, because like my house isn't going to blow up because the toilets blow up, but it's messy, and my wife's no likey. Yeah,
right. No, but you think about the transition period to the Eurodollar system from Bretton Woods to Eurodollars took place over a prolonged period, mostly the decade of the 1960s.
Right.
And it was a messy transition, but it wasn't something like, it didn't repeat the Great Depression, for example. We went into the opposite way with the inflationary extremes. But, transitions don't have to be short, sharp, violent, destructive events. They can be, high degree of uncertainty, sure, and messy to begin with, but I think that's part of the reason we have these discussions is because we have to let people understand or force them to understand that the way things are right now is not the best way of doing things. In fact, it doesn't really work, and so that we need to start thinking about what comes next, what we should be doing, because we're in such an unstable situation that if we don't do anything, that raises the risks of the violent transition.
Yeah, it's an amazing thing to sit here and watch this U.S. dollar denominated debt problem, Chinese dollar shortage problem, which is also a Chinese dollar denominated debt problem, just manifest into these massive bubbles, and just sit there saying, hey, if shit hits the fan, then find a different plumber or find one locally.
And I think, Keith, that's part of the problem too here is not only that this U.S. dollar system offshore exists in the shadows, it's a very complicated problem. What is a global reserve currency? You think about it from that perspective, it takes a hell of a lot of effort and infrastructure and logistics and support to have a functioning global reserve currency system. And that's one reason why the system has remained as it has, even though it's dysfunctional for all these years, is because there's no alternative. It's not like you could flip the switch overnight and say, as a lot of people say, the Chinese are going to take over, CNY is going to be the reserve currency. Well, no, they don't. I don't think they want that job because it's an enormous problem. I think the Chinese would argue, look, we would absolutely love to transition out of this Eurodollar rut that we're in, but it's not something that you can just design overnight and implement in a relatively short period of time. And so we're kind of stuck with this until we put together a legitimate plan of action, and which starts with understanding exactly what things are, how things work right now, or how they don't work right now.
Yeah, how they don't work is is an important point that you continue to make. All right, if I don't get some of these have some of the highest votes of all questions at the summit. So I'm going to the wood. I'm going to ask their questions instead of me continuing to ask you questions. And this is like Sarah Marie from Paris, France, and we do have a global audience. I'm always very proud of that because we don't want to be this myopic. Not to use name, I would never name CNBC or anything like that. But I mean, it's like we have a global audience that's educated. We are the macro aware. You're a person that has a lot of fanfare on Twitter as a direct result of that because you're quite knowledgeable on subject matter that a lot of people aren't, and you can articulate it. But she's saying, this is great. Let's just cut to the chase, Snider. The likes of Grantham expects a devastating market bust when the Fed is forced to tighten around late Q2, Q3 when the 10-year shoots past 2.25. Do you see the 10-year in this scenario going back to zero?
I think that there's probably over the intermediate and longer term a higher probability we see zero before we see, say, 2.5% or 3%.
And the catalyst for I know what mine are. I know what the catalyst is for that playbook. What is yours to go?
The catalyst for it is the next, what I think is almost inevitable dollar shortage episode. Like we go back and forth between acute dollar shortage and reflation, and the reflation is nothing more than the economy looks better. Growth and inflation expectations accelerate from extremely low levels, which in the mainstream gets propelled into this inflation narrative that it really isn't an inflationary scenario. And inevitably, because of the underlying global dollar shortage, this dysfunction in the Eurodollar system, because we never get any further than reflation, we just move from one shortage to the next, to the next, to the next. And that process was repeated 4 times already over the last 13 years. And unless something meaningfully changes in the monetary system, which is nowhere near on the horizon, we're just simply biding our time until the next dollar shortage shows up. Something provokes the banking system to tuck its tail between its legs and run back into its risk aversion position, which manifests in many different ways, including a rising dollar's exchange value, but also prominently lower and lower global bond yields.
Yeah, just so that everybody knows what that looks like, and I'm on this like a hawk. This is my whole model. If I were to use one, as Marcus Goldman said before Goldman became Goldman, the guy, Marcus, the guy who built the place, he would always say to the new people, hey, if you were locked in a room, a dark room by yourself, could you make money? And what would you look at if there was one thing? So to me, that's the dollar. How am I going to be a global macro guy without getting the dollar right? And I think a lot of people sit there with these views of what the 50-day bloody moving average of the dollar is doing. I mean, give me a break. I mean, that talk about prehistoric analysis. But if you look at slide 92, the broad trade-weighted dollar, you can look at it. If you're looking at this from Shiller's perspective, you'd say, oh, mean reversion, that thing is going to collapse. It started to go down. And every time it starts to go down off a mega cycle peak, like it did in 1999-2000, it's the beginning of the end, and that thing's going at least towards 90. What I think you just said, and correct me if I'm wrong on the dollar, and I can see this in my signal as well, because I measure and map the dollar daily and fractally using price, volume, and volatility, and the damn thing is done signaling lower lows. That's important. It's not signaling that it's going to crash. It's signaling that it's done. It's not done going down, but it's done like going down the way it was going down. And to me, the second part of what you said is that you get deflation when the dollar shortage reveals itself and dollars are well bid, because dollars go up and commodities go down, inflation expectations go down, the 10-year yield goes down. Agree,
it's
agree
almost
or disagree?
synchronous, right? All these things tend to happen. I mean, they don't switch and move into the same. They don't transition to the same thing at the same time.
Well, yeah.
You give it enough time, and they all end up moving in that direction anyway. And I think when you look at the dollar, it's important to look at a broad cross section of exchange rates, not just the dollar versus euro, for example.
Yeah, that's why I'm using the broad trade. That's the broad trade weighted dollar.
And I think a lot of people get caught up in DXY thinking that's the dollar when it's really just the euro. I mean, it's almost 60%, 60% of proportion of the euro. So if you look at a broader section of the dollar, which Keith, you were absolutely pointing out, what you see is, over the last couple of months in particular, on a short-term basis, the dollar seems to have caught a bid again, especially against some of the Asian currencies, which to me is a very important when we're looking at some of the shadow conditions in the Eurodollar system. Asia is absolutely crucial to understanding what must be taking place. And so if we see sort of this transition from reflationary weaker dollar from the highs last year into more of a stronger, at least a dollar bid type of situation that goes any further, then we have to start asking ourselves what's really going on here. Are we still in reflation at all? Are we transitioning? We're rolling over into another dollar shortage situation. Is that corroborated by the treasury market, inflation expectation? Commodity, oil, for example, having a rough time recently. The oil curve is now, in contango, at least in its front month, and a 3-month contango has collapsed pretty precipitously. So are we starting to see an accumulation of warning signs that this reflationary period may be reaching sort of, if not its end, maybe it's a short run end?
Well, the beginning of the end. Like exactly. I've been channel. Have you by chance read Green Lights by Matthew McConaughey or listened to?
No, I haven't.
That's good for guys our age, man. That's a
I
great
haven't
book.
even read Ben Bernanke's book all the way through. I could only get through the first couple of pages.
Oh, I read it. I underlined a lot in that book. There's I dog-eared that like a boss. That when you look at the dollar, the way I see it is, for whatever it's worth, is that we have the last 3 months of Quad 2, and then we're going to hit slide 20 again. We're going to hit Quad 4. Quad 4 has got the only rising and high expected value of the dollar going, it's a dollar up quadrant. And Quad 4 is also called deflation. So I do think it's going to be the beginning of the end. And at the end of the day, some day is always the beginning of the end.
Tie that back to China too, Keith. I mean, look, if the Chinese economy is not going to perform the way I think the mainstream narrative has said it, and the way a lot of conventional traders have positioned themselves, then you would expect risk aversion, especially in Asian currencies, because it's the Asian economies that are going to be most at risk from China not performing up to expectations. And so as we start to see some of these economic numbers from China that are really not that great, it makes sense that we would see that transition phase into perhaps potentially the next risk aversion episode.
Yeah, and when you say it has a tendency to, these things have a central tendency to all happen, at the same time. I mean, no shit. That's what it is. It's this is a nonlinear system like anything else in natural space. These similar sets collide, and then stuff happens. It's not like you just take this one thing, valuation of that thing, Fed said this thing. That's not the way it works. It's not the way that a globally interconnected market system with nonlinear functions works. Anyway, this next question from James in San Antonio. Jeff, history suggests that the Fed will continue to do what they're doing until they break something. Might you suggest what may break and what the Fed's going to have to do about that?
Well, I think we already reached that point, didn't we? To me, 2008 was the breakage point. That was it was not a one-off event. The Fed looked the other way. Ben Bernanke said to Milton Friedman's face, yeah, we'll never do it again. And then they proceeded to do it again. And what we mean by do it again is not understand their own job and how they're supposed to do it. And that hasn't really changed over the last 13 years. As you said, Keith, so you alluded to earlier, they try to kick the can down the road by doing these smoke and mirrors quantitative easing programs. And if we use the Japanese example, they can continue to do those types of things for a very, very long time. And Japan hasn't really broken yet, at least not in maybe the sense that I think the questioner was talking about. Now, Japanese society seems to have been really broken, and there are all sorts of more social types of consequences for the Bank of Japan's ineffectiveness. But in terms of the US and the Federal Reserve, we have a much bigger problem because this is a global monetary system that everybody seems to think that the Fed is in charge of, or at least can manipulate at will or easily at will. And that's just not the case. So it's not like that the Federal Reserve can continue to kick the can down the road forever, because eventually I think what happens is because the dollar system continues to malfunction and misperform, that eventually it starts to fracture and segment itself into individual smaller pieces. And I think we're already seeing that with global trade blocs starting to emerge, where countries are keenly aware of the fact that globalization is not proceeding the way it used to. And I think the monetary system and the financial system is another expression of how this dysfunction can manifest in bigger ways. So I don't know if it's necessarily something breaks, but the system continues to break down. And historically, that's what happens. You have a period of rapid globalization, rapid global growth that brings things together. And then as it sort of dissipates, all of those things begin to fragment again. And then we search for a new way to combine everything in something new.
Well, that's also like, when you look at conditional factoring of market risk, you have these big pillars of risk, which include many of the we've talked about, including demographics, leverage, deficits. When you look at the country level, how we've built the model, and again, you can sit there and read Zero Edge all day long about these topics, since 2008, by the way, where the beginning of the end was supposed to end every year since then. Well, unfortunately, it doesn't. For people that are purveying that view, it only starts to really matter. These structural issues matter when growth is slowing. When growth is accelerating, newsflash, dollars going down, other currencies are going up. Your dollar shortage problem isn't going to cause deflation. But when you start to slow and the dollar starts to rise, you see, like old Warren Buffett taught us. You see that tide rolling out, and you see who's got their shorts on or not. And to me, that's very obvious at this point. So
yeah, and it's funny how we go between two extremes, right? When we go into the deflationary period, the media narrative tends to be, or the mainstream narrative tends to be, this is it. This is the final end. It's going to all collapse and crash and everything like that. Then we go into the reflation, and everybody immediately goes into the opposite direction, where we're going to turn into 1970s U.S., if not 1920s Weimar Germany. And really, we go back and forth in the middle between those two things, because in a really beautiful kind of way, as crappy and as malfunctioning as this Eurodollar system is, because there's no alternative, it at least has the ability to keep the lights on in a minimal capacity and keep the whole thing at least the resemblance of effectiveness.
Yeah, that's a great summary of that too. Here's a pointed question, and we're running out of time, but still have time for this one, maybe another one. Jeff, the Federal Reserve has been, is, and will continue to lie to us. Do you agree or disagree?
Yes. I think the Fed's actual monetary policy is to lie. Now, they would say that we don't lie. We try to picture the truth in certain ways. We try to fashion it so that it's palatable to the public. But that's really what expectations-based policy is. If you don't do money and you do expectations, you're down to manipulating people's behavior, at least believing that you can manipulate people's behavior, which a natural extension of that, obviously, is at times you have to lie. And yes, and I think the Federal Reserve is very good and very crafty about the way it does things. Like, for example, the myth of money printing, quantitative easing itself. I don't believe I've ever heard a central banker equate quantitative easing with money printing, because they know it's not. But they're perfectly happy to let the media run with that idea, because it fits their expectations goals, right? If they want inflation expectations to rise, and the financial media, and as well as the financial services industry broadly, is willing to say, it's money printing on behalf of the Fed, of course, the Federal Reserve is never going to correct the error, because it suits their purpose. And so it's mostly lies of omission rather than outright statements of falsehoods.
Well, that's something I agree with wholeheartedly. That's
well, I'm glad.
What I guess my last question, like when you watch, because there's a different characterization of omission, I guess, is one way to put what you just said, from Bernanke to his underling, risen to all her glory, and Janet Yellen, to Powell today. Like, what is it about him that? What kind of lies or non-truths do you think he's best at?
Bernanke, I think Bernanke was very skilled at the technical aspects of econometrics, which if you started to challenge the guy on some of these plumbing issues, he would fall back into mathematical discussions, for example.
Right.
And so it really added, to the layperson, it seemed to add a lot of credibility to what he was saying, because he could cite all of these obscure, arcane references to statistics and mathematical equations and DSGE models and how they operate and things like that. And it made it sound like what he was saying was very scientific and objective and put together very well. He was really good at that.
Yeah, really.
Whereas Janet Yellen had her patented deer in the headlights stare at any kind of tough question that really didn't lend itself to expectations manipulation, because you kept looking at her and thinking, does she even believe what she's saying? At least Bernanke made the public believe that, yes, I believe exactly what I'm saying, and you should too. And Jay Powell, I think, falls somewhere in the middle, whereas sometimes he can appear competent and it's worthwhile listening to. But other times he has that sort of look on his face where he starts to fidget and kind of messes around, where you think, well, maybe he doesn't really know what he's saying either.
Well, that's the thing. That's the thing about the history of, whether you study kinesics or not. The study of people's body language and whether somebody is or is not telling the truth. I mean, there is a long history of political types that have been unbelievable, tremendous at having you to believe certain things, right? And that's, I'd have to agree with you. I mean, I'd say that Bernanke was convincing to people that wanted to be convinced of a certain storyline. And then you got into these two where you've had a lot more volatility in shorter periods of time between Yellen and Powell, where that episodic and non-trending volatility spike ended up being a new trend. And they have a hard time with that, real hard time.
Yeah, they don't know what to say. And their job is to sell their views to the public, which is really all the Federal Reserve Chairman is nowadays, is a public figure attempting to manipulate public opinion. And if you're not really skilled or good at getting the public to believe that you know what you're talking about, then you have an enormously hard task ahead of you. And I think that was Ben Bernanke's gift, was that he could take. Obviously, the guy had no idea what he was doing, because that's why we had a 2008 crisis to begin with. But that is not the public's perception. By and large, they thought the Federal Reserve must have performed well, because didn't you see the guy on TV? He was very credible. He was very well-spoken. He was very articulate. And that's not really how we should be evaluating monetary policy, nor economic and financial performance, whether or not they're good on television. But that's the modern age which we live in. These plumbing issues, these technical issues that you and I have been talking about, it's my sense that there's a lot more interest and probably capabilities at the staff level in these central banks than there is in the top positions. The top positions are all about these, policy appearances, whereas down in the trenches, so to speak, a lot of the staffers, or at least a few that I've talked with, they say the same thing. They can't believe this is what a central bank does. Really, we don't really know about anything much about the monetary system, but we tell everybody we do, and we're good at telling everybody we know what we're talking about, when they really do have a more concerted interest in some of the more plumbing and technical issues.
Yeah, I agree. We just hired a Fed staffer, so the proof is in the pudding on that. Very impressive young man who's wanted to get the hell out, obviously, but he also he had quite a few questions. Let's just leave it at that, about how certain things are done, and wants to help change the world. That's what we're trying to do when we're having conversations like this. And by the way, on the thing about looking good on TV, you look like him a little bit. We started that, and you were damn good today on Hedgeye TV. So thank you for that. Thanks for the education. I'm sure many others are also quite appreciative.
Thank you for having me, Keith. Always a pleasure.
Awesome. He's Jeff Snider. Awesome. That guy's awesome. All right. Last one, Steph Pomboy's next.